So the Mega Millions jackpot broke, I guess, $1 billion this past week. Begs the question, should you go buy a lottery ticket? Is that going to be the best strategy for your financial future? The answer, of course, is no, and we'll explain why. But certainly it's the kind of headline that catches our attention here on the program, along with this other one, which I guess is the financial industry's latest self-proclaimed crisis. And I guess more importantly, the product that the fabulous financial services industry is rolling out as the solution to this said self-proclaimed crisis. We'll tell you what that crisis is and what the product solution is so you can make sure that you stay away from it. Because after all, anytime the financial services industry creates a quote-unquote crisis or describes something as a crisis, history tells us that it usually means that it's more about marketing and not necessarily about performance. And when it comes to your investments, your retirement, your future financial success, well, performance should be the very first thing that is at that top of the list about what's really important. So welcome into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to have a range of alphabet soup initials from, of course, all of them being certified financial fiduciaries. Some of them are certified financial planners, others are CPAs, others are National Social Security advisors, others are IRS enrolled agent. A whole team of people that stand ready to help you improve your life with a successful and cost-effective financial plan. If you're not familiar with the program here on Dollars and Cents, we're one of Central Florida's longest running programs, also happen to be a top 25 financial planning podcast as well. So make sure you check us out on your favorite podcast platforms. Once you're there, make sure you subscribe to us, and then that way you'll get notified as to when we upload new content. If you got any trouble finding us, go to our website, nelsonfinancialplanning.com. You'll see the icons. Click on the one that is most familiar to you, and you will get directly connected to our program. Well, before I get much further, this show is originally airing on Easter Sunday, so we want to make sure that we wish everyone a happy Easter. As the calendar falls, this Easter Sunday marks the end of the first quarter of 2024. Tomorrow, April 1, well, that's second quarter. And I guess then it's a good point to take a minute and reflect on the start of the year, which in fact has been the best start for the markets in several years. The S&P 500, which for those of you who don't know what that is, that's one of the broadest market index that looks at the price-weighted average of 500 of the largest companies in America. So it's sort of a bellwether market index or sort of a benchmark performance that is a good representation of what's going on out there in the economy and the markets as a whole. So certainly a strong start to the year, up 10% in the first quarter. And with that, we thought we would give you a couple of statistics that we ran across this past week that really suggests that given the strong start to the year, history tells us that it actually portends well for the rest of the year. Now, if you're a client of Nelson Financial Planning, these two statistics you probably heard at our event this past week. because every quarter at Nelson Financial Planning for our clients, we host a series of educational events. We strongly believe and have always believed that the foundation to being a good investor is to be educated about what's going on out there in the world at large. So one of the biggest reasons why we've been doing this radio program for 35 plus years. Also, one of the biggest reasons why we have those educational events for our clients where we bring in speakers from, maybe it's a portfolio manager, maybe it's economist, maybe it's a tax expert, whatever the case may be. Important to bring those in. We do that every quarter. We had one such event this past week. Usually get a couple hundred people that come, have those at the country club, and engage in what proved to be an interesting conversation about growth investing, and looking for those opportunities in high quality companies that have existing track record. So an interesting conversation. If you are a client of Nelson Financial Planning, well, then that's the kind of thing that you want to make sure that you attend. If you're not, well, then what a great opportunity to come and visit with us and become a client. And then that way you get access to these kinds of events that we hold on a regular basis. But so the statistics, stat one, if you're looking at sort of the first 50 trading days of the year, which is usually January 1 to mid-March, the markets at that point, so this was probably a couple weeks or so ago, had risen a little over 8% since the start of the year, marking the 14th time over the course of the past 70 years, so going back to 1953, where you had seen an increase of at least 7.5% during those first 50 trading days. In the prior 13 occurrences, the median gain for the rest of the year was like 7.7%. So again, history suggests that, given the strong start to the year, that it may actually give very positive signals about what the rest of the year looked like. The second statistic, when the S&P 500 rose 8% or more in the first quarter of a year, it finishes the rest of the year even higher, 94% of the time, with an average gain of nearly 10% over the course of the next 3 quarters. So, and yes, these stats would also hold true despite it being a presidential election year. So some interesting historical data that we think gives some insight into what maybe the rest of the year might hold. As we say on radio and podcast land, stay tuned to see if history repeats or if something different happens. Speaking of history, hard to believe, this past week marked like the four-year anniversary of what was the sort of the COVID low in the market. Remember that all, it seems like 4 years ago. That was a long time. But it seems like it was just yesterday. But if you recall that period of time, as the parts of the economy were shutting down, everything was shutting down, the market, as you might well imagine, was reacting very quickly, and also declining in a rapid fashion because of the lack of information, the lack of information that is happening inside that period of time. So, but the interesting thing is what the market has done since then. If you measure from that low point, that COVID low, S&P annual return then over the subsequent 4-year period is like 25% per year. Just another example in the litany of examples that if you're making a big change in your portfolio, if you're panicking, if you're making adjustments when the world seems the darkest, that's usually a very poor time to make that. And the reality is that you will wind up missing out on opportunities. So important to be consistent even in the face of that negative news. So it was an interesting kind of sort of perspective on where we were just 4 years ago, particularly with those that COVID reaction to what was going on at the time. We're going to take a break, and we'll return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So happy Easter. As we mentioned at the top of the show, of course, this show is airing live on Easter Sunday morning. And so certainly we want to take a moment and wish everybody a happy Easter, which is falling in March this year, which is a little bit earlier. It seems to recall sometimes that Easter date always kind of fluctuates on the calendar, but this year it is falling in March, the last day of March, if you will. Certainly hope that you and your family enjoy the Easter holiday. Of course, it is still March, so I guess that means that March Madness for NCAA basketball continues. As you know, doing a little bracket challenge at the office. One of my Final Four picks, Auburn, was gone in the first round, so clearly I am not leading the bracket challenge at the office. I was probably being a little bit biased on that selection because Auburn happens to be my oldest son's alma mater. And they lost in the first round, so that didn't work out so well. Interestingly, the odds of correctly predicting the outcome of all 63 March Madness games are 1 in 9.2 quintillion. Now, if you don't know what a quintillion is, it's basically a billion. So that's 1 in 9 billion billions odds of correctly predicting the outcome of all 63 March Madness games. I guess the one that has made it the furthest is a guy by the name of Greg Nigel out of Ohio, who in 2019 is the only person on record to take a perfect bracket to the Sweet 16. But yet, we still try part of it. And I guess speaking of things that we still try despite overwhelming odds, maybe not as 1 in 9.2 quintillion, but odds that are pretty high nonetheless, is when we look at the conversation that always happens. I think this is the second or third time where we saw the Mega Millions jackpot go over that $1 billion mark this past week. And I guess here's the crazy part, and obviously not meant to be judgmental on it, but if you want to spend a few bucks on lottery or scratch off, okay, fine, that's your decision. The odds are completely against you. It's like 1 in 303 million to win, the Mega Millions. You got a better chance of getting struck by lightning. But for most people, if you're looking to improve your financial situation, it's not lottery tickets or scratch offs or anything like that. There are many more ways in which to improve your retirement picture that have much better odds than 1 in 303 million, especially when you consider the stats of what gets spent. So here's the number. And when I saw it, I really had to double check it because it just seems staggeringly high. And it really does cause a $1 billion Mega Million jackpot to pale in comparison. So this statistic comes courtesy of the North American Association of State and Provincial Lotteries. So I assume that their stats are correct. Last year, Americans spent over $113 billion on lottery tickets. That's right, $113 billion. $113 billion gets spent on lottery tickets last year alone. I'm wondering what it would look like if that same $113 billion was instead saved for retirement, was instead used to pay off debt, was instead used to build an emergency savings account so people can avoid using their credit cards when emergencies happen. $113 billion is a staggering amount of money. But that's how much Americans spent last year. Doesn't that number shock you a little bit? I mean, really, think of what could be done with that money rather than spending it on lottery and scratch off and all that kind of stuff. If your real goal is to improve your finances so that you can enjoy your life more, let me just give you a suggestion. And you can do this with the same amount of money that you would spend on average on lottery tickets. And we have this example in our book, Next Gen Dollars and Cents, and because I think it's an important one, because it really does underscore how you don't need a lot of money to become a millionaire over time. And when you look at the example that we have in the book, we compare two investors, investor A, investor B. And on this program, I'm going to throw in an investor C. And so investor A saves $250 a month, starts at age 22, and does that for a 10-year period of time. Now, $250 a month, I mean, it's a little over $50 a week. Is that, hopefully nobody's spending quite that much on lottery tickets or scratch-offs, but sometimes I've seen people do that, standing in line at convenience stores and the whatnot. And when you think of $250 a month, that in comparison is not a significant amount of money. So investor A, $250 a month, starts at age 22, does that for a 10-year period of time, and stops. At age 65, and again, this kind of assumes a 10% return in line with the historical averages. At age 65, that cumulative investment, $250 a month, 10 years, turns into over $1.3 million. That's how you become a millionaire. And in that case, investor A, he only did it for 10 years. Investor B waited 10 years, started at age 32, saved that same $250 a month, did that every year until they were age 65, 34 years in total, and lo and behold, well, they didn't quite have $1 million. They had over $800,000. So two important concepts to that, right, which is if you start early, then the power of compounding clearly works in your favor. But even if you start a little late, you still wind up with a considerable sum of money, much greater odds of getting to those dollars than the 1 in 303 million odds to win the Mega Millions jackpot. We're going to toss it in a third option, an investor C, if you will. They're the person that does the $250 a month and does that every single month, starting at age 22, going out to 65. Do the math. They've got over $2 million that they were able to save during that period of time. Again, kind of assuming that longer-term historical average of roughly around 10%. Pretty significant. Pretty significant when you stop and think about it. And that's certainly a great path to become a millionaire, right? Skip the lottery tickets, the Mega Millions, the scratch-offs, all of that kind of stuff. Start saving a little bit of money, $250 a month. If you can't do $250 a month, do $50 a month. It doesn't matter. Okay. Start saving that money. Do it consistently. Do it over time. And you'll become a millionaire. You don't need to get scratch-offs or jackpots or anything like that in order to do that. Just be consistent and start early. So some thoughts, if you will, on how truly to achieve financial success here on the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions. Hopefully you, after hearing this segment, you've come to the conclusion that, okay, maybe I shouldn't be buying lottery tickets and scratch-offs and things like that. Maybe I should just be saving my money and investing it along the way a little bit each and every month. Those are the kinds of things things that we're here to talk about and have been talking about here on one of Central Florida's longest running radio programs, also a top 25 financial planning podcast. My name, of course, is Joel Garris. I'm with Nelson Financial Planning. We're going to take a break and return after these messages. So did you see the latest pronouncement out of BlackRock last week? BlackRock, for those of you who don't know, manages about $10 trillion in assets, money across the board, right, for all American households individually, inside 401ks, all of those types of locations where you would be saving money. And as a result, they own a significant portion of pretty much every company that is publicly traded by virtue of the widespread use of their funds and ETFs and things like that. Now, if you follow the folks at BlackRock, led by a guy by the name of Larry Fink, you know that this is the same group that was one of the biggest pushers, if you will, of the notion of tailoring your investments to address climate change and the climate crisis. And again, not saying that there aren't some things that need to be concerned about there in terms of the climate and protecting oceans and water and air and all those kinds of things. But the reality is that our contention is always that you don't make investment decisions by favoring one company over the other because of political wins or exclusionary factors or based on your view of whether their goods, products, and services that they offer are or are not contributing to whatever the crisis is that you are focusing on. As we said at the beginning of the program, the number one factor when it comes to investments is performance. So if you're eliminating or thinning out the pool of potential investments simply because it's, I don't know, an oil company or something along those lines, then you may be missing out on opportunity. And so this whole climate crisis, as sort of pushed by BlackRock, gave spawn to the entire ESG movement, which if you're a regular listener to the program, you know that we've talked about that at length over the course of the years. You know, we're not particularly big fans of it. Again, comes back to performance is always key, and don't necessarily look to pass judgment on the type of product. If it is a profitable product that consumers are demanding, then it should be part of your portfolio. And at the end of the day, when you look at kind of this ESG universe, the performance has been not particularly good, right? Because of the exclusionary way in which kind of these investments are picked when you're kind of running these ESG screens. And so today, the reality is most investment managers have really kind of pushed away from that, all kind of running away or sort of unsubscribing, if you will, from some of the pledges that were signed back when this was such a major part of the conversation. Vanguard immediately springs to mind, was a signatory of this global initiative and has since sort of walked away from it simply because, again, from a performance perspective, it was causing performance to underperform. So the folks at BlackRock, having tried and kind of failed on this ESG climate stuff, now are pushing a new self-described crisis, and this one they are referring to as the retirement crisis. So again, part of all this ESG stuff, part of our view was that it was always really kind of more about the marketing, sort of like the .com stuff that we saw 25 years ago getting rolled out. Oh, you got to own something that's got .com in it, and you're going to be fine, and then then the performance really isn't there. And so the same thing is true when you look at ESG and climate change based in investing. And so, once again, folks at BlackRock are giving it another shot and now saying, oh, we've got a retirement crisis. And at the end of the day, that's not anything new, because you got, people spending money on lottery tickets and scratch offs, and not just simply saving money and putting it away on a regular basis. And so we all know the average American doesn't really have enough saved. U.S. Census Bureau latest survey of consumer finances found that nearly half of Americans aged 55 to 65 reported not having a single dollar saved in personal retirement accounts. That figure, when you hear it, it is alarming. It kind of matches the same percentage of the population who doesn't pay any income taxes either. So that's obviously a topic for another show, but those numbers always seem to kind of be similar. The issue I have, of course, with all of this, with BlackRock kind of fixating on yet another self-proclaimed, self-described crisis, is that after their failed efforts at climate crisis ESG fell flat, once again, they're pushing another crisis with the notion of marketing, because at the same point they're telling, oh, we've got a retirement crisis, they're also saying we have the solution. And anytime you say you've got a crisis, but yet I have the solution, doesn't that strike you as just sort of like marketing, right? I mean, that's at the end of the day what it is. So they are fanning those flames of this self-described crisis and also announcing the launching of their latest new product that's going to solve this issue. Isn't that great? We announce a crisis and then we roll out a product to solve it. That's marketing, folks. So the latest product is one that is called this Life Path Paycheck. And it starts out with sort of a target date type fund. Okay, so if you listen to the program regularly, nothing really earth-shattering about them. There's millions of them out there. All, unfortunately, have subpar performance, because what those target date funds do is they get too conservative too early. That's always our contention. When you look at the numbers bear that out. But here's the real kicker on their latest offering, if you will, is that at age 59 and a half, in this BlackRock product, Life Path or whatever it is, Life Path Paycheck, you get to purchase an annuity from one of the insurers that's been ever so carefully selected by the folks at BlackRock. So rather than offering products that historically deliver less than what the market does, understand how an annuity works, right? So an annuity basically involves a third party, i.e. an insurance company, that promises to then deliver you money over a period of time. So he asks a very simple question. If you think you're going, which way do you think that equation is going to fall? If you're giving your money to a third party who ultimately says, okay, I'm going to give this money back to you over time, do you think at the end of the day, where they're going to ultimately pay you more or pay you less than what you might otherwise get had you done your own investing? And the reality is, of course, that you're going to get less, because after all, the third party, the insurance company, makes profit. So at the end of the day, this goes back to teaching basic personal responsibility and basic personal finance. Yes, you have to save money for the future. Very clearly, you need to do that. More Americans need to do that than what has been being done in the past. But you also need a basic understanding of finances. There's a ton of books out there. Ours, of course, is one of them, and it's available on Amazon, just like all the other books, and an internet full of websites that can certainly help. Bottom line, and I think these two subjects are related, whether it's the newest, greatest product or buying lottery tickets, is you got to get started on saving money today. And don't have the financial industry make you think you need an annuity or a new product to solve something that is very clearly on its face solvable just by simply saving a little bit of money each and every month and being consistent on it and starting early. Anyway, with that, we're going to take another break here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm with Nelson Financial Planning, and we will return here on Dollars and Cents after these messages. Certainly, to be clear, there is a retirement crisis in America. Not enough Americans are saving money for their future. Not enough Americans are saving money to even have an emergency savings account. But the solution, in our view, is not, in the case of BlackRock's self-proclaimed crisis, to roll out yet another product that is purely driven by marketing and not by helping people obtain a better understanding of their finances, a better understanding about financial literacy. That's one of the biggest reasons why we wrote our book last year, Next Gen Dollars and Cents. And everywhere you turn, you see these surveys. The one that I saw just this past week, the lack of financial literacy in America is nothing short of staggering. The most recent study on this showed that ages 15 to 18-year-olds scored an average of 64%, only 64% on a financial literacy test, with over half, 51% of the participants in the study failing the financial literacy exam. This is the real crisis, folks. Because it starts at an early age in terms of getting on the right track or getting on the wrong track from a financial perspective. And the importance of understanding your finances and making good decisions. My goodness, we give out our book on a regular basis at the office, especially if it's somebody that's opening up a minor's account and you've got a kid just starting out, or a kid that worked a job at McDonald's and now, okay, fine, I want to fund an IRA, I want to fund a Roth, all of those kinds of things. It's just so important to really have those right tools, and nothing we think is as important as that. And then again, one of the reasons why we do this program, been doing this program for as long as we have. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. If you're listening to the show live, then that means it must be Sunday, which is Easter Sunday, which is the original airing of this program. So we hope that you're having a very good Easter with family and friends. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks who happen to be certified financial fiduciaries as well, that stand ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. And that is so crucial in today's world. If you've been listening to this program, you know that bottom line, this show is really about emphasizing getting started early, getting started with something, and being consistent, and the power of that time and compounding. The example that we were giving early in the program about how much that money turns into it, just $250 a month. If you're starting out at age 22, and you do that each and every month from 22 to 65, you have over $2 million. Folks, that's how you become a millionaire, not by buying lottery tickets or scratch-offs or anything else, but really just focusing on the fundamentals, if you will. And so important to do that on a regular basis. You know, a couple of weeks ago on the program, we were talking about some of the ads that had appeared on Facebook, and a lot of the ads were that were running, that we were talking about in the program, had to deal with various scams that were using artificial intelligence generated likenesses of people that encourage you to sign up for their group little chat and then ultimately start subscribing to their personal chat, and then there you would get these phenomenal stock picks and become rich overnight kind of thing. And the reality is that they were in fact scams looking for your personal information and your money. And so it really did lead to kind of an interesting conversation, because you certainly have to be careful about what you're looking at. And we would say the same thing as it relates to your portfolio as well, because oftentimes when you look at an investment portfolio, you don't really see exactly what it is that you own. And if you think of a portfolio that might be a bunch of mutual funds or a bunch of ETFs or those kinds of things, it doesn't give you a good picture in terms of what's the underlying investments, what's the underlying holdings that ultimately are owned inside that particular portfolio. So what you really have to do is you have to kind of look behind the scenes, look behind the curtain, if you will. And one of the ways in which we do that at the office is we use kind of a tool called a Morningstar X-ray that really does look through the different investments that our clients or folks that come into for the first time own, and really make sure that it's not getting overly concentrated in terms of risk or diversification, in terms of the types of companies that are in the portfolio, and in terms of the specific names that are in that portfolio. Because sometimes when you look at ETFs or funds, you'll see a lot of the same names from one fund to the other. So you may very well have some hidden risk in there or some hidden concentration that you didn't realize. And so that's one of the things why we always sort of talk about kind of digging into the details and really sort of looking at more of an X-ray type analysis that allows you to really see, okay, what is it that I own? What are the sectors that I'm exposed to? And sometimes it can be surprising. There was an individual just this past week that came into the office. As you know, if you kind of listen to the radio program on a regular basis, you know that we're running these ads that sort of ask that question. Do you know the risk in your portfolio? Do you know whether it's diversified? And offering a complementary service for folks to let us screen that portfolio so that we can see if there's any particular hidden risks or costs or diversification issues that you need to be aware of inside yours. And that's something that we're doing absolutely free here in the second quarter of the year for folks. And so there was someone who took us up on this offer, and so they came in the office, and it looked like on its face it was like a stock. It was a stock portfolio. It was 50 different stocks, and it looked, okay, yeah, a bunch of different names, and all of that looks fine. But then when we ran it, what was shocking is just how aggressive growth, how limited to basically only two sectors of the economy. And when you think about the economy, generally it's thought of as that there are 11 different sectors in the economy in terms of the types of companies. In this particular case, it just had basically two sectors, and it was very much more aggressive, much more growth oriented than you would ever really have seen just by looking at the names of the companies. And what's really crazy about the entire story and the entire individual involved is they were in the process of going through a divorce. They were in the process of a major life change, and ultimately looking to retire, looking to generate out income. So the portfolio that they had, and especially in terms of risk, certainly did not match what they were looking for in terms of ultimately their investment objective, which was to get some income from the portfolio, and of course get some growth, a little bit of growth on top of that as well. But to have an aggressive growth portfolio that's concentrated in two sectors, that's just not how you're going to be able to do that successfully over time. So bottom line, it's really important important to understand your investments, understand your investment allocation, and make sure that it's geared for what it is that you're trying to accomplish at whatever stage of life you are in. With that, we're going to start to wrap it on up and get on out of here. You've been listening, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial podcast as well. If you're interested in taking us up on this free offer to look at your risk in your portfolio, feel free to reach out to us. Give us a call at 407-629-6477 or visit our website to schedule a free conversation with us at Nelson Financial Planning. Our conversation's always free of charge, so make sure you reach out to us as well. With that, we're going to wrap it on up and get on out of here. This has been Joel Garris of Nelson Financial Planning here on Dollars and Cents.